So, what's this high-frequency trading thing anyway? All right, everyone, gather round, because today we're talking about something wild. It's called high-frequency trading, or HFT if you're cool. Imagine trading stocks at lightning speed. We're not talking about clicking a mouse and waiting a few seconds. Oh no, this is a whole different level of fast. It's like the Flash, but instead of saving people, he's trading stocks. And he's doing it thousands of times a second. Yes, you heard that right, thousands. It involves incredibly powerful computers. Think of the beefiest gaming PC you've ever seen, then multiply its power by like a bajillion. These computers are so important that companies literally build their offices right next to the stock exchange's computer servers. A millisecond, a thousandth of a second, can mean the difference between making millions or losing them. These supercomputers run complex programs, and their whole job is to buy and sell financial stuff, stocks, bonds, currencies, you name it, in tiny fractions of a second. It's a volume game, played at speeds we can barely comprehend, making trades faster than you can blink. Now, let's throw another fancy term into the mix, artificial intelligence, or AI. AI is also a huge player in this high-frequency trading game. These aren't just simple programs anymore. We're talking about AI algorithms that can learn and adapt. It's like giving those super-fast computers a super-fast brain. How do these AI algorithms actually work in HFT? They are designed to spot incredibly small changes in prices. Imagine a stock price wiggling up and down by an amount so tiny you wouldn't even notice it on a normal stock chart. These AI systems see those wiggles. They analyze massive amounts of data, news articles, social media trends, historical price movements. Once the AI spots a pattern or a tiny, almost invisible price change, it makes a decision. Buy, sell, hold. And it does this instantly. This allows trading firms to react to market information faster than any human possibly could. When all the robots think alike. Okay, so we have these super smart, super fast AI traders all trying to make a quick buck. Sounds efficient, right? Maybe even good for the markets? Well, hold on to your hats, because here's where things can get a little dicey. What happens when lots of these AI algorithms, all programmed by very smart people who probably read the same textbooks, all spot the same tiny signal at the exact same microsecond? You guessed it. They all try to do the same thing at the same time. It's like a digital stampede, everyone rushing for the same tiny exit. Imagine a really popular new video game console drops. Everyone wants it. The website opens and bam, millions of people and bots all hit buy at the exact same moment. The website crashes, right? Or it sells out in seconds. Now imagine that, but with billions of dollars in the stock market. If a piece of news comes out, or a particular market indicator flashes a certain way, multiple AIs might be programmed to interpret that signal as sell everything now. Or buy like there's no tomorrow. This simultaneous reaction can create a massive, sudden surge of orders in one direction. This creates a feedback loop. One AI sells, which pushes the price down a tiny bit. Other AIs see that price drop and their algorithms say, oh no, the price is falling, we need to sell too. So they sell, pushing the price down even further and even faster. It's like a giant money avalanche, folks. To really get what happens when all these AI traders stampede, let's use an analogy. Think of a snowy mountainside. It looks peaceful, stable, maybe even a bit boring, like the stock market on a slow Tuesday. Now a tiny pebble, that's our small market signal, maybe a weird news headline or a tiny price fluctuation, gets dislodged. It starts rolling, pretty insignificant on its own. You wouldn't even notice it from the bottom of the mountain. This is like one or two AIs making a small, initial trade based on that signal. No big deal, right? But as that pebble rolls, it bumps into a few more small bits of snow. These bits of snow, representing a few more AI algorithms, also start to move. They see the initial pebble or the movement it caused, and their programming says, hey, something's happening, let's join in. So now you have a slightly larger clump of snow and pebbles rolling down. The movement is becoming a little more noticeable. More AIs are detecting the price changes caused by the first few AIs and are now also reacting, adding their own sell or buy orders to the mix. This growing clump of snow starts to pick up speed and gather more and more snow. Should robots run Wall Street? Flash crashes happen when market prices plummet rapidly for no obvious reason. The 2010 flash crash saw the Dow drop nearly 1,000 points in minutes. Billions can vanish, shaking market confidence. It feels like a casino rigged by super-fast robots. These events highlight the risks of algorithmic trading.